Holy moly, guacamole, macaroni, and everything in between, whatever that means. Volatility is not subsiding. I feel like I'm in, an ocean of very, very rough waters. And I don't do well out in the ocean on a boat in the rough waters. I get pretty seasick. And I feel a little seasick, but we're doing our best to navigate that here on the Stock Market Brief Show. I wasn't planning on putting out a video today, but some sentiment charts updated, the wild, crazy price action, and a couple new charts that I want to bring in just to give you a good visualization of where rotations are taking place. So today's episode, it is a good one. Tomorrow, I'm going to have a weekly recap. If you're new here, welcome to the channel. I use technical analysis and intramarket analysis to get a good idea as to where the market might be headed next. If you have been a subscriber, welcome back. Make sure to hit that thumbs up. That's how you sponsor today's video. Yep, that right there. Hit the thumbs up and subscribe. Let's get into today's show. Welcome back, everybody. What started off to be all green and a lot of happiness quickly turned into this. All red. Yes, wild day in the markets, looked really good out of the gates, and we got that bounce. Yesterday's show, if you didn't watch it, what did we talk about? If you don't know, I'll tell you. We talked that be very careful on bounces because they could potentially get faded. This bounce, it got faded and it closed down hard. Let's take a look at the advancing and declining issues. 81 advancing issues, declining 420. Look at the capital, look at the volume. Another big down day on big volume. Not that great. Ugh, where's the bounce? Where is it? Here's the percent of stocks above the 200-day moving average. We cracked lower, right? I'm not going to go through the analogy of the termites eating the house. If you want to see that analogy, go watch the video yesterday. This is not good. Why is this not good? Well, it's now saying over 80% of the stocks in the Nasdaq composite now are below their 200-day moving average. Ew, gross. And I'll tell you what, last time we saw some big drawdowns like this, like these ones here, these ones that are highlighted with these negative divergences, it was like an 18 to 20% pullback from peak to trough. This was like a 23 or something like that, and this was like a 30 peak to trough. We're down like 13%, 10%, 12%, somewhere around there. I didn't measure on the Nasdaq composite. So if we could have some more downside to go, right? Like I said, when you get these overextended areas, you do get bounces sometimes, but you got to be careful on the bounces, as we saw today. So, yeah. Let's look at Peloton. Got some news out. You probably already heard about it. I just want to point out that, dang, if you don't think a stock can go down further than where it currently is, use this one as an example. It's down 86% peak to trough. All right? So if you don't honor your stop losses, this, what I talked about yesterday, if you're like, for example, you're like, hey, I'm just play a breakout right here. Cool. that made sense. I would play probably a trade like that. I didn't, and if you're like, yeah, I'll play a breakout, but I'll have a stop right here. And then it keeps coming down and you're like, no. And it gaps on you and you don't use your stop, right? And you're like, no, it'll come back. It always comes back. Come on. It always does. It fell off very hard. Probably by then you capitulated. Then it ran up. And then you're like, get back in. And then it sold off further. All right, so once again, let this just be a leading example that, yes, high-flying stocks, they can go down, and they can always go down more, right? Think about that. It's down 86%, but from where it's at right now, it can fall another 86%. That's how it works, right? Think of it this way. Here's 100%. Here's 100%, okay? If you go down 50%, it'll cut it down to here. You can go down another 50%, that'll be leaving 25%. Then you can go 50% of that, 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 50% of that. Losses work geometrically against you, is what I'm trying to say. So if you can control your losses and keep it tight, keep it under control, you'll do significantly better in this game. Enough of that rant. I wanted to keep today's video short. Netflix, after hours reporting earnings. What does this tell me? It tells me be very careful this year going into earnings, especially tech. Pretty much everything, be very careful going to earnings. You can look at the expected moves that the options market is pricing in prior to this and just be prepared because it's going to give off a big number. And this one is already way outside of its expected move that it priced in. It's about 2 deviations from that. Okay, down 21% after hours. It's in a bear market overnight is what that is. Another bear market, I should say, right? It's already down from, peak of around 620. Now it's down to 410. All right, let's take a look really quick at the dashboard. Utilities up there, financials, consumer staples. What does this tell me just out of the gates? Defensive posturing. That was the only green one. So defensive posturing makes sense. Everything was in the red. All right. Dow Jones was down 0.89%. Okay, but this is where it gets crazy. If you just look at this right now, you're like, it wasn't that bad. Small caps down 2.12. The S&P 500 was 1. Okay, that is small potatoes of what we actually saw during today. We saw a big gap up. We saw a rally higher. So from peak of today's trading activity down to where it closed off today, it was significantly higher. Like the Dow Jones from peak to trough was like 800 points. So volatility, like I said, is here. And we'll go back to those charts here momentarily. What happened to the dollar? Dollar was up slightly today. Nothing really like that in the slightest. Okay, we'll continue to watch the dollar to see if anything rapidly changes here, right? There's a lot of people predicting the dollar to eventually roll over. There's some people predicting that it's going to be a big squeeze to the top. You know what I say? I say I don't know what's going to happen. I'm not trying to predict what's going to happen, but at least we can prepare by looking at certain levels. If we all of a sudden see a big spike up in the dollar, that's probably going to start tugging down gold, start tugging down silver, start tugging down other assets. You might be able to look at that as like potential flight to safety as people just flood into it. Now, there's been plenty of times where the dollars went up and golds went up with it. So we got to take it day by day. Breathe. Take it day by day. Okay, let's continue on. Yields. Spread to note. Got flatter the 10 and 2. Very important one to watch. It's at 0.75. The lower this goes, the closer it gets to inversion. The 35 didn't change, and you can just see that here, right? The 2-year keeps on ripping grip. So we'll see what the Fed says next week. Are they going to do a rate hike? Are they going to announce that they're going to rate hike? I don't know. Some people say no. Some people say once. Some people say that the market's pricing in right now 5 rate hikes, apparently. Ugh. We'll see. We'll see how the Fed, what they can do in an environment where growth is slowing and these curves are flattening out. We'll see. We'll see what they can do. It almost seems like they have to do something now at this point. God, man, it's gonna be wild, and we've already noticed that here. It's wild. 10-year yield slightly up on the day, just sideways, little doji indecision candle. You can tell like these smaller bodies, it's slowing momentum, but right now it's just consolidating. Can it head higher? Yeah, it can still head higher. All right, it hasn't showed us getting below 1.8. It's still holding above there right now. However, when you look at the TLT hit its lower weekly range. We talked about that, I think, yesterday, or I can't remember if I talked about that in my Discord or on a video. So forgive me if I didn't mention that on a video. But we did hit the lower range of this. Sometimes resistance can become support, and we started bouncing. Now we're kind of wedging here, so this might be a potential good play to get back in to potentially just. I would say it would be potentially a good play, and the reason why is a chart that I'll show you later in this video. So I hope to remember to bring this back up. But just note, it is wedging here. It's a big move to the downside, right? It's been in this trading range overall, and it came out once, and it came out again right here, but it tagged this lower range, and it's very possible that we come back into the median, which is around 145 still. Okay, that's still on the table at this particular point in time, and I'll show you a chart here that makes me kind of think from a relative standpoint that could happen. Let's take a look at some sentiment charts. The NAM, whatever you want to call it, what are asset managers doing? You can see here as the market was pricing in, confidence waning. Okay, Ridex, what's real money doing? Getting a little bit more bearish. So we're getting a 56.73 reading. When we get below 50, that's been actually a pretty good contrarian indicator to potentially go long. The last time we were around 56.73 was right around this drip right here. That little drop right there is where we got that same reading. We don't get down here all too frequently. So, it's not too much. Don't put too much weight on this one, but just be aware that what are asset managers doing? Well, they're getting more bearish than they were prior. And the bearishness has been building, as you can see, here when it's above 100, if you don't know what this is, right? That's like full bull, like very euphoric, leveraged long positions. And when it starts backing off, that's when, cash positions start to increase. Now, if you take a look at the bull to bear ratio, and these are just surveys that are taken. You have a bull, bear. One thing that you'll notice as this chart updated, got a lot more bearish. We don't get these readings all too typical, although also, if you look to the left of the chart, it wasn't until around the pandemic when we had a reading. So we haven't got this type of reading for, quite some time. Pretty much during all this crazy market volatility right here, if you remember that those wild swings back and forth, and we're kind of feeling those wild swings right now. Another thing to note is the ratio itself has been waning completely. It's just been whoop, as the market's been whoop, going higher and higher. All right, and we don't get these readings frequently at all. You can see like here, like just very, very sporadic on these random little pullback areas here, all right? Like I said, don't put too much weight on this, but as you can see, people are getting more bearish. I like to look at these as contrarian indicators. And it's by contrarian, I mean when it gets really, when everybody's super bearish, that shows me that there's more fear, and that's when I typically like to start to look for these setups to potentially press a little bit. As it stands right now, it's not overly bearish, but it is getting more bearish. Let's look at the SPY. All right, so yesterday we drew out what the options market was pricing in for the remainder of the week. This is what I mean by very volatile. We gapped up, started the day off good. We rallied higher. We tagged the upper range, and then we sold off to the lower range. Yee! That's crazy. Absolutely wild, wild day in the markets. Very, very, very volatile. What are they pricing in tomorrow? They're pricing in more volatility. A $6 move, $6.15. We'll just call it $6 move so the math is easy. All right, so we had a close 446, so 452-ish, come right back up in this range. And if we continue to sell off, that can bring us down to around 440, all right, which is right by the 200-day moving average, right by around this gap, okay? So if it does come down there, this is what I would say to watch for. If we get a gap down, look for red to green, because that means people are going to start trying to accumulate here. That could be a capitulation type moves where we see some sort of a bounce. So we did get that bounce, but immediately sold off. So you still need to be very, very careful. Also keep in mind this, blue lines. That's what the options market priced in the prior week, right, for this week. And 70% of the time it ends up being in here. If it doesn't, as we stated, if it gets far outside of it, you can see some wild price swings take place as new dynamic hedging takes place. And what you can see is we're getting out of that, and it's getting wild, right? Another thing that we mentioned yesterday that I want to just revisit is it got below 450, and even below this low right here, 447.50. And what we discussed was if it starts getting below there, I would imagine that the VIX is going to start ripping. Okay, so careful here. This is not a place to be a hero, right? If you're being tactical intraday, that's one thing, but you got to be careful, right? So yesterday we talked about this. I want to bring it up again as now the video is already going too long. I said, if you're short right here, be careful, right? Why? Because on these extended type moves, you can get a snapback, and that's what we got. We gapped up and we rallied straight up. Would have definitely closed out a bunch of short positions and would have helped either the short covering of that if people were short, which I assume there's always people that are short. It starts helping, and then also you have buy the dippers, so you have that and potential early day momentum traders too. So the price runs all the way up, and if you're paying attention to levels, that's where you'd want to take profit. And then we started selling off. That would have been the place to short, as we discussed. So as the market, I wouldn't think that the market's going to go pretty much straight down for the remainder of the day, but that's what happened. All right, stocks, they take the stairs up, and the elevator down. We've been in a weird market where they've been taking the elevator up and the stairs down, but overall, you should know stairs up, elevator down. That's how it goes. Next chart, VIX. Not much to report here other than, yes, we started to explode, but we're still not all that high. We still have this gap and this gap here that can potentially get filled. Now, I will note that the RSI is getting pretty darn frothy overall. So look for these potential areas of resistance. One other thing that I wanted to just call out is this little blue box that I drew here for fun to draw a little smiley face. That's all. No, I'm just kidding. The reason why I point that out is just because I noticed that there was a trend line heading down this way, and you could see it broke out, came back, and then started ripping. So I thought, oh, okay, potential looking type inverse head and shoulder, pattern here. I don't put too much weight on that, but we did break out. We retested the trend line, so a full measured move of this would take us up into that range. So if it's in this zone up here, that's why I'm just kind of talking about this. It kind of lines up with this gap too. So watch out for that as a possibility. I don't know if that's going to happen tomorrow or anything, as we're already really extended, which I'll get into when we get into the Qs. Let's look at the BPSPX charts. RSI is not oversold, so that means that we could potentially still have more room to go down. What number are we? So 51.4%. So when it gets below 50 range, we have, gotten bounces. But me personally, I like to look at the RSI for positive divergences, negative divergences, overextensions to the upside and to the downside. And that's when I feel a little bit more comfortable, kind of finding a position to take. And we're not there yet. Okay, so let's look at the IWM. I'm going to quickly go over this. IWM looks like garbage. I guess there's really no other way to say it. So if you want to buy right here and get lucky for a bounce up, cool, awesome. But right now it looks like garbage. It is well over, it's getting overextended. That's for sure. This feels like a crash to me. By all means, it's very violent, and you can see that in the volume profile. Not the volume profile, but the volume down here. Excuse me. As the market was going down, right? Volume was going up. We rallied. What do we say? Be careful for, right? Lowering volume. Market sold off. Volume went up. Rallied. Lower volume. Careful. Market went down. Volume went up. Not good. That is bearish. All right. So if you are looking to potential short the IWM, I would say, yeah, not right here. That I wouldn't short right here. A big move has already been made. So now if you're trying to short intraday, look for pops into certain moving averages if you want to do it that way. If you're trading on a daily time frame shorting, that's a little bit different. I would look to see some sort of a bounce or some sort of relief bounce, but there's going to be so many setups in various different stocks. I would like to see something set up before that. So as we already had a big move down on big volume, I would personally, to short it, I would like to see a rally on low volume into an area of resistance. So to 1250 maybe. Okay, we've got to play it as time goes. I can't really predict something that far out into the future without the price action here to kind of help guide me, and it's just not there right now. Options market is pricing in a $4 move tomorrow. Gosh, holy moly. So we're right at around 200. So that puts us right around here to around that 204 to 205. And that brings us down here to around 196. So we could still head lower. And that 196, let me go to the left of the chart. Ooh, look at where that lines up at. A gap fill that hasn't been filled. Yeah. Pay attention to that level. If we get more further downside, you might need to play an intraday bounce. Okie dokie. Qs. All right. Qs. Pricing in a $6.29 move tomorrow. That's crazy. We're going to just call it 6. All right. So that can take us pretty much right up into this range, which is where? Right where the options market priced in where the week would end. Now, yesterday we talked about what the options market was pricing in, and it hit the upper range and it came right down basically to the lower range, just about. A couple levels that I want to pay close attention to, and a couple things that I want to really quickly discuss. First and foremost, Netflix just had earnings. Is it going to put that much pressure on the Qs? I think it could apply pressure. I don't know to the extent of what type of pressure, because it hasn't had too much relevance as of lately as it's been falling, okay? But we did call out this level as a gap fill. So what I want to see is look tomorrow for a red candle to green candle. So if we get a gap down and it starts seeing strength, that could be pretty positive. Just be very tight with your risk, okay? As far as intraday trading goes. 200-day moving average, we crack right below that like butter, all right? And it looks like it's targeting 360, which is that gap fill. Gap fills, they can act as support. So is this where we bounce? Potential, but we need to get some sort of confirmation, and a confirmation could simply be something from red to green. All right, so that's what I'm going to look for tomorrow. If we take a look at the Nasdaq McClellan oscillator, that's also moving into overextended territory, which leads me to believe on a red to green candle, we can very well see another bounce. But as I've already stated, be careful with bounces. Okay? BP NDX chart, not quite overextended to the downside, but we do have a positive divergence that's still forming, which lets me know that we got to be just on high alert for a bounce. And why do I say high alert for a bounce? Am I saying that because I want you to buy the dip? Not necessarily. I'm also talking to people that like shorting the market. All right. So if I say that there could be a bounce, just note that, you know, if you're shorting and the market has already made a very strong move to the downside, that means that you're basically stating that you think that the market's going to continue further down. All right. But, you know, as far as a risk to reward goes, you want to be able to, you know, try to get the most reward with the most minimal amount of risk. And if the market has already made a significant move, you know, you got to be patient for it to reset up. And as far as a short goes on the Nasdaq or the Qs, I think it can go lower, absolutely. But I just wouldn't short right here. Or if it goes straight down, I wouldn't short right here. I would wait to see how things set up. Because we've already seen countless times this market turn back around to just rip faces off. Okay? So that's still a strong possibility. We're going to go into a couple of stocks now. Tesla. It looks like it's walking a very thin line. This candle right here, not looking too good. Nope, not at all. Inverted hammer as it's just kind of walking this wall right here at about 1,000. If it starts cracking down, it looks like it could head lower. Where can it go? Well, we have a lower Bollinger Band and a 100-day moving average. And that seems very plausible. Why does that seem plausible? Because that also coincides with the gap fill right here at around 950. So that can be an area. Another place to pay attention to is this acted as resistance. We had a breakaway gap, ripped up higher. We pulled back, we filled that gap, and it acted as support. All right, so that range in here, this box, could potentially be watching out for, okay, for a bounce. And then also, price is kind of wedging. This has actually been doing pretty well relative to some other stocks. And it's maybe one to watch, right? So we'll keep an eye on those levels. Just be careful because this is also a very volatile one. Alrighty, let's take a look at NVIDIA. NVIDIA was down pretty significantly on the day. What I want to point out here, though, is it has been extensively selling off. Hasn't really seen too much of a bounce whatsoever. So the area that I'm keying in on is this gap fill, which also lines up with this prior area of resistance and this prior area of resistance for a potential bounce. So we're looking at around 230. So if you are short, I think it could still potentially reach down into this area. Once it gets down there, that's where I think the shorts would probably start covering and you'd have some buy the dippers step in. So that could be an opportunity around there with a good low risk entry to potentially play for a bouncy boo. Quickly, I want to show you semiconductors. Why? Well, some big, huge sell-off taking place as it cracked down through this area of supports on some big volume. Very nasty. This right here is what I'm talking about, like a lot of fear and a lot of panic, potential capitulation. I think that it can very well head lower and come down to that 200-day moving average, but I want you to just see some areas that other people might be keying into where you might get that short covering or potential bounce plays intraday. All right, be very careful applying big positions during times like this, during high volatile times like this, as you're trying to navigate the rough ocean water over here. So the position size is the key thing that you want to focus in on, as well as, you know, low risk entries. The level that I'm looking at, prior area of resistance, that's just under 275 to around 275. We're not far off. It looks like it can reach it. And if we do get a gap down tomorrow, I would say that 200-day moving average, which is right at about 267, 268, right around there. And then if we do get a gap down and we get a tag that, we might see an intraday bounce to watch out for. Just note, sometimes, right, resistance can become support, but support can also become resistance, okay? So if we start breaking back down here, it could be very well, once again, another wall of resistance. So keep that in mind. Let's look at Apple really quick. Apple, strongest one from a relative standpoint, potential head and shoulders, as it broke this neckline. A lot of the times you'll get retests. So I can see a potential retest up to around 168. And lately, head and shoulder patterns, they haven't been working too good. We get a move right back up, you know, further, and then it comes back down and then goes something like that. So, you know, it is what it is, but there's a couple levels that I want you to call out. One, breakdown right here. Okay, so that can act as support, right? It was support. Now it can act as resistance if it comes back in. So that's a potential area to look for potentially shorts. And then also prior resistance can become support. So if we pull back further around the 100-day moving average, 156 to 158, if we get some aggressive type more selling to take place, that is something to look at. Okay, now if we take a look at the FANG ratio, so Facebook over SPY, Apple over SPY, NVIDIA over SPY, etc. Okay, relative strength. This is the chart that I wanted to show you earlier. The next one coming up here soon. Okay, relative strength, you can see nothing's looking good relative to the SPY. I mean, Facebook's been going flat, but it's well under a declining 5-period moving average. Apple is the only one holding up with an uptrending 50-period moving average. NVIDIA crossed down below, and that was our warning sign when we said that. We said it's holding. Careful when it starts crossing below and heading down further, and we can see more sell-off continuing. Google trying to get its legs, but it's just been heading down. We've been watching that. Microsoft's been heading down, trying to turn up a little bit. Amazon looks just gross right now. Okay, and we saw that in today's price action. And Netflix is going to look destroyed even more than it is right now tomorrow, which this has been on the bottom of the list. We've been talking about this one multiple times, saying just how bad this looked. And now, go figure, on earnings, this thing ripped down even further. Now, I want to look at some more tech ratios because tech has been high flying, right? They've been doing so good. Well, from a relative standpoint, if we can look at software, computer services, electrical equipment, telecommunications, renewable energy, these are different industries within tech. And what I want to just call out is semis cross down. All right. You have electrical components and equipment. It's been going flat, but it's below it. This one looks like it's about to go below it, which is telecommunications equipment. Okay, equipment. Electronic equipment still down. This computer service looks like it's trying to turn up, but the 50-period moving average is relatively flat to neutral. The only one that's kind of holding up right now relative to the SPY is computer hardware. Okay, now this is where it gets interesting. Notice how this is all weak that I'm showing you, and I'm talking about that. Hey, where's that rotation potentially going into, right? Look at the safety. Flight to safety. Clearly, from a relative standpoint, you're starting to see these things just turn up aggressively. All right, so gold relative to the SPY typically performs well from a seasonality perspective. It's doing that right now. Okay, declining 50-period moving average, starting to rip up. XLU over the SPY. We talk about that one too frequently. 50-period held as support, starting to rip up further. XLP, consumer staples, defensive, starting to go up further. TLT, this is what I wanted to call out earlier when we looked at the TLT. Just now crossed above the 50-period EMA. So it's something to watch. It signals to me, now this is still a declining 50-period moving average, but it signals that now we're in a period of risk off where we need to be very careful. Yeah, there could be bounces, but to me this states that, hey, this could be the start of the TLT performing better than the S&P 500. Is that going to hold above? I don't know. But if it does, this was your early indication of it right now. Defensive over the S&P 500 has been floating above the 50-period moving average, starting to curl up, and it's doing well too. And then healthcare also, it's been trying to get above, and it just recently did too as well. So more defensive, risk-off type posturing, rotating into those defensive areas is taking place. The last thing that I want to call out and close off with is this, as this short video turned into a long video. Back to this chart, the summation index and the NIMOT, the McClellan oscillator, okay? We're not there yet, but like I stated previously, when this is below zero, when it crosses below zero, and this gets a reading of minus 300 too as well, things could get pretty crazy. All right, it happened here. We went off a little bit, but then we bounced, but then we sold right back off. So volatility. Volatility was increased for higher periods of time. All right, here. Bam, that was into 2018. And a lot of people are saying this, what's going on right now, seems very similar to 2018. Okay, so bam, we sold off pretty hard. And then obviously to the pandemic, this crossed down below zero a little bit later on. And then this crossed below that minus 300 reading, leading us to obviously this sell-off. So like I said, we're not there. We're getting a minus 223. It's minus 300. No, this is not a holy grail crash indicator, but if we look at history, and it told us one thing before, you might as well just acknowledge it. All right, a lot of people try to predict, and they act with so much confidence, like they know for sure something's going to happen. No one does. No one knows without absolute certainty, but we can look into the future, or into the past, sorry, and have some past occurrences help navigate us through this wild, wild ocean that we're in. Yeah. All right, everybody, that's all I got for you.